Are you interested in investing in private mortgage funds and curious about how long you have to commit? In this video, I'm going to cover the typical commitment term for most private mortgage funds, why funds require a commitment term, how to find mortgage funds that are accepting new investors, and I'll also tell you about a new trend I'm seeing for mortgage funds that do not require a commitment term. I'm Butani, CEO of PrivateLenderLink.com, where investors and brokers can easily find direct, private, hard money lending companies throughout the United States. If you're in the investment real estate business and want to gain insights into private mortgage lending, subscribe to our channel and get notified every time we release a new video. For those of you who are not familiar with private mortgage funds, also known as mortgage pools, they are essentially mutual funds that invest in private mortgage loans. Multiple investors pool their money, and a fund manager makes the decisions on behalf of all the investors as to which loans to invest in. Most mortgage funds provide short-term bridge loans secured by investment real estate as opposed to owner-occupied homes. Some of the common terms you may hear to describe these private mortgage loans include private money, hard money, or bridge loans. And a fund is a securities, so in order to invest in them, you have to be an accredited investor. As with many other types of investments, when you invest in a mortgage fund, you have to be prepared to commit your money to that fund for a certain period of time. Most fund managers don't want you using their mortgage fund like a checking account. If you make an investment in a mortgage fund and want to pull some or all of your money out of the fund, you typically have to wait until the end of the commitment term and then provide a written notice to withdraw your money, which could have an additional set term. The commitment term is also called a lockup period or a lock-in period, and the notice term is typically referred to as a redemption notice period. So what is the typical commitment term or lockup period for private mortgage funds? Most private mortgage funds have a minimum commitment term of 12 months and a redemption notice period of 90 days. These are just the typical terms I see from most mortgage funds. Some require you to commit for longer, say 18 to 24 months. In 2020, I started seeing a number of new mortgage funds that don't have any lockup period at all, and only a redemption notice period of 30 days. I'll explain the difference with these liquid mortgage funds in a bit. I first want to explain why mortgage funds even require a commitment term. The way that most mortgage funds work is the money in the fund is lent out to real estate investors that have a short-term financing need. It could be a bridge loan to acquire a property, cash out refinance, a rehab fix and flip, or a ground-up construction project. Ideally, a fund manager would want all of the money in the fund to be invested in these short-term loans, which earn interest every month, and the income is distributed to the fund investors. The reason you can't just pull out at any time is your money, along with the other fund investors' money, has been put to work and is invested in loans. You have to wait until one or more of those loans have been paid off before the mortgage fund has enough money to pay you. And the average lockup period is 12 months because that's the typical loan term for most of the short-term bridge loans that the fund invests in. Some loans will pay off earlier than 12 months, and some loans may need to be extended. Mortgage funds that require a commitment of 18 to 24 months are likely investing in construction loans, which generally need more than 12 months to complete. What if you really need the money and cannot wait until the end of the commitment term? You can always make this request with a fund manager, and if it's possible, maybe they can make an exception. But keep in mind that the fund manager has to protect all the other fund investors. If one investor pulls out, it may affect the earnings of the other fund investors. Perhaps if the fund has a sufficient amount of money on the balance sheet, which has not yet been allocated to loans in the pipeline, it may be more possible. Or the fund manager may have to ask another fund investor to invest more money to make up for your withdrawal. Now let's talk about those highly liquid mortgage funds that have no commitment term and no lockup period. The way these work is that all the loans which the fund invests in are immediately sold to the secondary market within 10 to 30 days of the closing. There are lots of institutional note buyers that love to buy short-term private mortgages, so the fund manager will underwrite the loans according to the note buyer's guidelines to assure that the loans will be purchased and taken off the fund's balance sheet within 30 days. There are many private lending firms that use this business model of selling all the loans they fund, and most of them have a bank warehouse line to recapitalize. However, getting a warehouse line for private mortgages is not easy, and there is always a risk that the bank will pull the line if there is a credit crunch or a major economic event. A liquid mortgage fund is a great alternative to a bank warehouse line. The cost of capital is typically higher, but it can be more reliable. When you invest in these liquid mortgage funds, you can request to withdraw your investment at any time, but you still typically need to give a 30-day redemption notice because the fund manager needs to know how much money to allocate to new loan fundings. This could be a great benefit for investors who want the flexibility to get their money back quickly. But one downside is the returns for these liquid mortgage funds are typically lower than mortgage funds that hold the loans in the fund's portfolio. Whatever your commitment term preferences are, there are many mortgage funds out there that are continually seeking additional investors. And if you're looking to invest in private mortgages, use our website privatelenderlink.com as a resource. We have a directory of private mortgage funds throughout the United States. There is no fee to search and no registration required. When you get to the homepage, click Investments in the main menu bar, then select Mortgage Funds to see the list. Click on each company's profile to learn about their investment offering and look for the commitment term field. If you'd like to inquire, scroll to the bottom of the page to find the fund manager's phone number and a short form to send an email inquiry. Just to clarify, I am not an investment advisor and do not endorse any of the investments listed on our website. Each investor must conduct their own due diligence and evaluate the offering prior to investing. The companies listed pay us a monthly or annual advertising fee, not a commission. Also, there's no set placement for the investment section of our website. The investment search results are randomized and should change when you select a filter or reload your browser. We do offer top placement opportunities in the lender searches of our site, but that's for loan origination targeting borrowers and brokers, not mortgage investors. If you found the content in this video to be useful, please click the like button and be sure to check out our other videos about private mortgage investing. Thank you for watching and see you in the next video.